Hey everyone, welcome in to another daily editorial here on the KE Report, getting an update from Heliostar Metals. Very, I think, significant acquisition that the company announced just yesterday, July 17th, to acquire a gold portfolio of producing mines and development projects in Mexico for $5 million US. This is a strategic acquisition of former Argonaut Gold assets. I am chatting with Charles Funk, President and CEO of Heliostar Metals. Heliostar is traded on the TSX Venture Exchange under the symbol HSTR, on the OTCQX under the symbol HSTXF, and the Frankfurt Exchange RGG1. Charles, let's just start off with the headline here. You're acquiring a portfolio of producing mines for only $5 million US. This deal, I guess just on the title, seems cheap. We'll get into some of the finer nuances of this deal, but how did it all come together?
Yeah, thanks, Corey. It's a tremendous deal. We thought buying it for this price was probably too good to be true as well. Argonaut announced that they were selling their assets in Mexico late last year, I think it was, and we didn't think we'd have a chance at them. We thought the sale price would be materially higher. As it happened, it's now public that Argonaut, or the new Florida Canyon Gold Inc., is selling all of their assets. The Nevada assets are being sold as well. And the Mexican assets are unique. They're not quite big enough for the big guys, but they're significantly too big for the small companies. So there wasn't a great pool of buyers in the last couple of months. And so, yeah, with our relationship with Argonaut, I think we were very fortunate to be in the right place at the right time to buy the Mexican assets to allow the Nevada sale to proceed.
So the market took notice of this deal, high volume update for the company. Can you simplify the opportunities here for Heliostar? Because it was less than a couple of years ago, you were an exploration company just with a little focus in Mexico. Now it seems like you're going to be a producing company.
Yeah, we've got a long stated goal of becoming a 500,000 ounce a year gold producer. And so we've systematically worked over the last couple of years to achieve that. And there's a lot of levers in this transaction, but if I try to simplify it to what matters the most, we're paying $5 million to acquire the portfolio. That immediately cancels $20 million of contingent payments on Ana Paula, our flagship development project. So on that value alone, it's a great transaction. We take on two producing mines that will give us immediate cash flow, which is what every junior company needs and should desire to achieve. And it also bolsters our development pipeline with a lot of high quality development projects, a couple which we'll pursue shortly, and some in the long term. We are taking on the closure cost liabilities of San Agustin, but as we'll talk about, we think that there's a lot of upside before that comes. So we trade away immediate liabilities that we trigger as we build Ana Paula for cash flow, development projects, and a great long-term growth pipeline.
So simply the terms of this deal, $5 million US. There is a loan facility that was announced for between, I believe, $5 to $10 million. Take us through all the terms, any nuances kind of behind that $5 million price tag.
Yeah, there was an iteration of the deal terms where we were going to pay that cash up front. So we organised a loan facility to do that. As it happened, the terms evolved and we don't have to make a payment until closing, which is anticipated in 3 months. We believe that we will have enough cash flow from the assets to pay for that, but it's prudent to have a small working capital facility. So we'll pursue that in line with now becoming a gold producer.
Can we talk about cash flow forecasts? What can come from these two producing mines immediately?
So we intend to put out production guidance on closing. We're not able to put it out until we close. But to give a sort of a ballpark for what people can expect, we believe the assets will produce, somewhere in that 35,000 ounce range from now until the end of next year. We think that we will generate enough cash flow in the next 3 months that would actually cover the acquisition price. So it's incredibly attractive given the gold price in the short term and the ability to generate cash flow to pay the acquisition price from operations at San Agustin in the Colorado.
Okay, so I get Argonaut's being broken up here into a number of different companies, but just what you said there, you're able to potentially pay the cash flow out to cover this price tag. Why is this all happening? Is there something behind the scenes here that could be an extra liability for the company or could have an issue for Heliostar down the road?
Yeah, I think it's the potential closure costs or potentially the perception that Mexico has right now. So there's about $20 million in closure costs when we choose to close the San Agustin mine complex. We don't intend to do that in the near term. There's significant reserves, some with permits, some without, that we plan to exploit. La Colorada, we actually think we can bring back online as a quality development project. We think it's got the potential to produce about 50,000 ounces a year for at least 6 or 7 years. So I think if you're not comfortable in Mexico, maybe that's a reason to lower the price. But we've loved our experience in Mexico. We break this transaction down into what we can deliver as a baseline, and that's that rough 35,000 ounce number I gave you. Nothing has to change for us to deliver that. And then we have a series of upside opportunities from there.
Now, are these the costly opportunities, development opportunities, one that will cause you to maybe raise more money or build up a much larger cash balance?
No, that's the best part about this. I think I break down the opportunity right now into four categories. So, first of all, there's the immediate cash flow. So, that gives us the cash that we need to run our business, our corporate G&A, our holding costs, our operations, and our development. Secondary to that, we see a number of opportunities. Obviously, at this gold price, the potential to exploit areas of these mines that weren't economic before will be something that we'll be looking at very closely in the coming months before we take over ownership. Then, in the big picture, Ana Paula remains our flagship. We are planning to bring that on at a 50,000 ounce a year run rate and then scale up to 100,000 ounces in our current thinking. And we see a lot of opportunity that I touched on at La Colorada and one of the assets that we're acquiring. There's a 380,000 ounce reserve. Effectively, Argonaut didn't keep doing the stripping because they needed that money for Magino. And so instead of a sustaining stripping, it's a new capex project. It's too early to indicate definitively, but it's definitely sub 50 million to do that. And we think the economics will be attractive. So two really quality development projects that, with permits today, take us to 150,000 ounce a year production runway. And then we've got this great asset base that's 3.5 million M&I ounces plus Serra de Gaia that will ultimately grow. If we could permit the open pits, then we transform nearly all the way to our corporate goals of 500,000 ounce a year production.
Okay, so you mentioned Ana Paula, still very much the flagship here. Is there this potential, bringing on these assets, cash flowing right now, that can fund Ana Paula rather than simply bring it into small scale mining and grow that direction?
Yeah, I think give us a couple of months to put the pieces all together now. I don't think it'll go all the way to fund that, but I think it goes some of the way to fund that, which by itself is extremely beneficial. So we're going to sit down now and work out exactly how the dominoes fall. But you're right, Ana Paula is still the Ferrari in our collection. We think La Colorado is going to be a really nice add-on to that, and we think we've got nice cash flow in the short term to knock those two dominoes over. I think it's a bit like that image where a small domino knocks down, and by the end of it, you're knocking over some pretty big slabs. And I think that's what this portfolio allows us to do. And Ana Paula is definitely one of the big slabs in that line of dominoes.
All right, now one thing that you've mentioned a number of times in passing is the permitting in Mexico. It's what a lot of investors have been focused on and really just wondering about when it comes to permitting these different assets, development, even growth. What do you need to do first? What issues could you come across? Where do you see those opportunities?
Yeah, so it's well known that right now you haven't been, or at least under the AMLO presidency, you haven't been able to get an open pit permit. It's still legal and every company can go to the courts for their rights, but bureaucratically it hasn't been progressing. There is now a change with Claudia Sheinbaum coming in, and so everyone's waiting to see whether she will be more moderate than the previous administration. And I don't think we yet know whether that'll be the case. And so that's why we've built our business case up. We've got the production that we've got and the ability to develop Ana Paula and La Colorada with permits in place or easy to get permits. And then we have a longer term pathway. If we can start getting open pit permits for the new projects, Serra de Gaia and San Antonio, then this will be one of the greatest deals I've ever done in my career.
Charles, I give you credit, man. This has been a very fun story to follow along with when you first brought in Ana Paula and now bringing in these other assets. You are moving very quickly into being an actual production company and one of okay scale, too. If you're talking maybe 35,000 ounces here, what sort of class does that put you in for companies? What sort of marketing material are you putting around for investors to balance out just what sort of market cap this company could be?
Yeah, I think if you compare us to our peer group in Mexico, which I would suggest is Go Gold, Vizsla, Prime, if you look at an ounce in the ground basis, we're materially undervalued with the most advanced projects with permits and production. So I think we're in for a pretty significant re-rate on the back of the transaction. We're one of the most aggressive management teams out there. We are building a mid-tier producer, and we pride ourselves on delivering on the statements that we make publicly. And so all our marketing and material will be, this is the goal that we're getting to. This is the course that we think is the best to chart. And these are the milestones along the way that you can hold us to account. And I think the key differentiator for us is high margin projects. We're not interested in scale for the sake of scale. We want a return per share to be the basis of all our investment decisions. And removing the 20 million liabilities, let alone all the benefit that comes from this asset, I think speaks to that discipline in this transaction.
Well, and it sounds like you're not even funding this through issuing shares. You have a loan facility if needed, and you even said this could all be funded just through production. So, hey, Charles, very interesting. Thank you for taking time to chat with me about this deal. I'll post a link to the news release in the show notes. Please, everyone, read over that. Send me any questions you have on this deal, and I'm happy to get Charles to address those. The company is also hosting a webinar on July 25th at 11 a.m. Pacific time. That's 2 p.m. Eastern time for you to further ask your questions. I will post a link to that as well. Charles, again, thank you very much for outlining this deal to us.
Thank you. Great for having me.